Chapter 8, Question 3a. In this example, we have a company which has their inventory card for an item A903 for the following details in 2019. You'll notice that they're all in the month of March. The plan of this exercise is to use the perpetual method of inventory recording and to calculate the value of inventory at those various dates using two different methods, FIFO, first in, first out, and weighted average cost. We'll walk through FIFO first. So we were told that as of March 1st, they had 60 units in opening value at $70 per unit, which creates a value of $4,200. The next items to record are the fact that they had sales on March 5th, 40 units. First in, first out, we only have one costed unit for this item, A903. So for the unit cost is $70 each for a value of $2,800, reducing the total value of inventory to $1,400 for 20 units. The next transaction says to purchase 120 units at $74. Well, now we have two different costed items. Okay, 20 left at $70 and 120 at $74 for a total value of inventory of $10,280. But it's important to keep track of these items separately for first in, first out calculations. March 18th, we sell 70 units. So in this situation, we actually have to break down our sale into two components. We only have 20 left at the $70 rate, so we will sell the first 20 of those 70 at the $70 rate and 50 at the $74 rate. Remember, this is all about the cost of goods sold, not necessarily what we actually sold them for to the customer. This is about the cost of our inventory. So after this transaction, we now have 0 items left at $70, and we have 120 take away 50, meaning 70 units left at the value of $74 each for a total inventory value of $5,180. The next transaction says on March 24th, we purchased 44 units at a cost of $80 for a total inventory increase of $3,520. It's another new costed item. First in, first out, we need to track them separately. So we will now have 70 units at $74, 44 at $80 for a total inventory value of $8,700 for those items. March 29th, we will sell 100 units. Again, we only have 70 remaining at $74 cost. So we'll take the first 70 at $74. The balance being 30 units will be at the cost of $80, leaving our inventory with a balance of 14 units at the $80 per unit for a total inventory cost of $1,120. The last transaction being on March 31st was to buy 50 units at $90 each. Again, another different costed item, so we will have 14 items remaining at $80, 50 items at $90, for a total inventory cost of $5,620. For the month of March, we purchased 214 units. Total purchases into inventory were $16,900. Our cost of goods sold under FIFO is $15,480. We have 64 units remaining. Total value of our inventory is $5,620. The next part of this question says to do the same entries but use weighted average cost. So in this situation, we still have the 60 units opening with a value of $4,200. We sold 40 of them, dropping our value of inventory to $1,400 for 20 units. March 9th, we bought 120 units for a value of $8,880. We now have 20 units plus 120 is 140 units. Our total inventory is the $1,400 plus the $8,880 for a total cost of inventory being $10,280. Increasing our weighted average cost, $10,280 divided by 140 units to $73.43 each. We roll that forward to our sale as of March 18th. We sell 70 units at our weighted average cost of $73.43 for a total cost of goods sold being $5,140.10, leaving our value of inventory at $5,139.90. Obviously it's rounding, but that's okay for this exercise. The next purchase was on March 24th. We bought 44 units for $80 each, 3,520. So our inventory went from 70 units to 114 units. Total value went from 5,139.90 cents plus the 3,520 to be 8,659.90. Bringing our average unit cost of the total value divided by the number of units to 75.96. March 29th, we sold 100 units at the average cost of 75.96. Okay. I rounded this number, that's why these changed slightly. It's all has to do with rounding, and that's okay if it rounds slightly because you need to have even units, okay? And you need to have pennies. You can't have less than pennies. So rounding is fine for these work. So we have a total adjusted inventory after the sale of 100 units of $1,063.90. Last transaction March 31st is we bought 50 units at $90 each, increasing the value of our inventory from $1,063 plus 45 to 5,563.90 cents. Total number of units is now 64, so our average unit cost increases significantly to be $86.94 each. For the month or as of March 31st, we purchased 214 units, the same $16,900. However, under weighted average cost, our cost of goods sold increased from $15,480 to $15,536.10 cents. Our closing inventory balance is the same 64 units, but our closing inventory cost is $5,563.90, and that's just the impact of the weighted average cost for items that are increasing over a period of time. The next part of this question asks us which inventory valuation method should be used when merchandise includes perishable products, otherwise known as items with expiry dates, and why. Give an example. So in this situation, we are recommending the first in, first out inventory valuation method should be used because it's the best match inventory with the physical flow of the goods. The plan is, say it was a bunch of oranges. The idea is they want to sell the oldest oranges first because they're likely to rot otherwise. So in this documented response is, especially when goods are perishable, first goods purchased should be the first goods sold. We don't want them to go bad and not be sellable. Otherwise known as FIFO would be appropriate. So this works for fruit, vegetables, bread products, meat, dairy, etc. I hope you found this helpful.